Now, a small topic that I think I should discuss today only, that is corporate governance norms for systemically important. So this session we are discussing now, this is a separate session for corporate governance norms. Now, these corporate governance norms are applicable to two types of entities. One is CICs. Of course, there are few differences for CICs, but majorly same. And another is systemically important NBFCs, or we can say systemically important NBFCs or ML. उनके लिए लगता है corporate governance norms. Now, these corporate governance norms are not applicable to NSI. These are applicable only to SI. Most of the regulations that you will see, whatever is applicable to NSI is applicable to SI. I don't think, apart from leverage, I cannot recall. There are some differences into income recognition, but also their NSIs are much better off. But apart from that, majorly what I can recall, NSI regulations are applicable to SI, but SI has some additional compliances as well. So when you talk about SI, these are the specific corporate governance norms that the SI has to comply with. Three committees to be, now these are very direct, simple requirements that you have to comply with most of the crowd here, with some of the compliance and legal background. I'm not getting in, I don't have to explain what the committee is, how the board functions, all those things we are already clear on. There are three committees to be maintained by an SI company, that is audit committee, nomination remuneration committee, and another is risk management committee. If you have the audit committee, not less than 3 directors, and also you have to comply with section 177 of the Companies Act. So either requirement comes under section 177 or not, you have to comply with. But in any case, if you're dealing with an SI, its asset size is more than now it's 1,000 crores. So those requirements would most of these requirements would touch upon. I don't see any scenario where it won't. Then there is a nomination remuneration committee, again to be complied with as per section 178 of the Companies Act. The job of nomination remuneration committee, sorry, here we refer it as nomination committee. Companies Act refers to as nomination remuneration committee, but it's the same committee only. There is no two separate committees for those. The task is to ensure fit and proper of the proposed and existing directors. Now, what is fit and proper? These are basically criteria that are specific criteria prescribed for directors of NBFCs that they have to meet so that they can be appointed as directors in an NBFC, a systemically important NBFC. Okay, the job to ensure that this is met is with nomination committee. RBI is very strict on fit and proper criteria of directors. They won't allow directors that are not meeting fit and proper criteria. You know, we have already discussed this regulation. If the change is more than 30%, you need to intimate, you need to take a prior approval of in directors, you need to take the prior approval of RBI. We have already discussed. So RBI is very strict on who are the directors of the NBFC, because they are the one who runs the company and they are the ones who can influence. As I said, NBFCs are very crucial for the economy. Their actions can have an economic impact. So it's very important. Another is risk management committee. The only thing regulations prescribe is risk management committees to be formulated besides asset liability management committee. Now there are two. Risk management committee, you all understand. Okay, you need to manage risk. What is asset liability management committee? Of course, I will discuss this committee in very much detail when we discuss upon the LRM framework, that is liquidity risk management framework. Just to give you an overview, currently, asset liability management committee is specifically appointed to look after liquidity risk of NBFCs. When I will discuss LRM framework, I will that time explain you how crucial is liquidity framework. Liquidity risk is one of the most significant risks by NBFCs. It's one of the only risk, I think, that has a separate framework for itself. So entire just the maintenance of one risk, that is liquidity risk, has an entire RBI's framework. We will discuss that as well in detail. That's a very important part of NBFC regulations. We will discuss why is liquidity risk so crucial. So to manage those risks, there is a committee called Asset Liability Management Committee. So apart from that, you require a separate risk management committee. So these two cannot be merged. There has to be two separate committees. As I was mentioning, maintaining of risk or risk regulations is a very important part of NBFCs, because as I have discussed in the previous session, NBFCs tend to have a domino effect. That is, one NBFC going down takes down multiple NBFCs, and a smaller NBFC going down can take down much larger NBFCs with it. That's how financial sector works, because the entire financial sector works on the basis of trust. To ensure that, we need a very strong risk governance. To ensure that there are multiple regulations around that. One of those regulations is appointment of chief risk officer. Now, what does chief risk officer mean? A person who is responsible for entire risk management. But now here you need to understand, as I mentioned, that the risk management is a very crucial function. This person holds a very crucial position. But you need to understand that when I'm talking about the risk officer now, he actually comes in conflict with the management of the NBFC. I will take you a simple example. What happens in two banks? Okay, so in banks, there are usually two departments. One is sales department, which is responsible of selling of loan. Another is credit assessment department, that or credit department. That credit department does the underwriting of the loan, whether the loan fits in the proper criteria or not. These two departments are multiple times at conflict. Why? Because sales would want to make more and more disbursement because their interests are linked with more and more sales happening. At the same time, credit would be stopping them from making unthoughtful decisions in the loans that are not meeting the particular criteria. So they both come in conflict. The same happens when we appoint a chief risk officer as well. The senior management, the CEO, CFOs, their intention or their role is more focused on the development of the bank they want, or the NBFC, they want to take the disbursement ahead. Sometimes this may bring them at conflict with the chief risk officer, who might want them to act more and more diligently. Okay, to ensure that they do this, a chief risk officer is required to function independently. One more requirement in the middle, the only NBFCs with asset size more than 5,000 crores required to appoint them. They need to function independently. To ensure that they function independently, board has been given responsibility, one, to appoint them. Second, they will appoint them for a fixed tenure. So when the board is appointing, board will take कि भाई हम तुम्हें 3 साल या 5 साल इसके लिए appoint कर रहे हैं. Board will appoint them for a fixed tenure. Any change in this tenure, termination before this, transfer before this, would require board's approval. At the same time, this has to be reported to the DNBS, that is Department of Supervision of RBI, as well as if you are a listed NBFC, you will need to report it to the stock exchange, because CRO is a very important position. We will want to ensure that he acts independently and he is not feared that his job would go away if he speaks up. Okay, so these are the board also need to put in a policy to ensure that the CRO acts independently. So this a very important position. This was all about chief risk officer. Another important regulation for maintaining the risk is that a same partner cannot conduct audit of the company for same partner of a firm cannot conduct audit for more than 3 years. Here, one more thing I would like to add up. There is a separate framework for appointment of auditors by NBFCs. This is a task for you all. Please go read those regulations. I'm not going into entire detail. I will of course share across the content for reading. We have that published on our website. You can read those. If you have any concerns on it, please let me know. One term we discussed some time back, fit and proper criteria. Now, what is fit?
Sorry to interrupt.
Bolo.
So, this chief risk officer, can it be a person who has an additional role in the company as well, like a CEO? Can he be appointed as a CRO? Double hatting is allowed or not?
So what I recall, double hatting is not allowed. Okay, because double hatting brings him in conflict. But I would have to once check on the regulation parts if the regulation specifically are permitting. But see, I have to maintain his independence. Whenever I do a dual hitting now, independence is somewhere impacted by it.
Correct.
Okay. So dual hitting exact restriction is there or not, I'm not very much able to recall as of now. But anyway, it's something that would not be suggested.
Thank you.
Now, was brought up. Sorry to interrupt you. So the applicability of the CRO to be appointed, it says that it has to be more than 5,000 crore. So once that trigger point is met, so directly be appointed. But what if the trigger point reduces? So is the like similar to LODR compliance? So does it have to continue for a tenure and it has to be below the trigger point for a particular period of time so that the provisions of this are not applicable? Or it has to, how does it function here? The applicability of the corporate governance norms.
See, once I've appointed a CRO, okay, he will continue for the fixed tenure. Any removal, even for any regulation, would require a board approval and intimation to DNBS and stock exchange. So anyway, he will have to complete the tenure.
But
and then they will have to complete the tenure. If the asset size is below 5,000 crores continuously, and even the CRO's tenure has ended, then maybe we can rethink on the appointment that we may not be able to do it. We are not required to do it.
So regardless of the asset size, that's only applicable for CRO, but the corporate governance norms should be applicable to all systematically important NBFCs.
Corporate governance norm is applicable to all NBFCs. Okay, systemically important NBFCs. They have to comply with it. So audit committee, evaluation committee, risk management committee, the rotation of partner, fit and proper criteria, all those items that I'm discussing currently are applicable to systemically important.
Only
This
the CRO
particular
is the
scheme,
exception.
CR is an exception. Because you understand that's a separate person, bringing in a separate person to sit and manage your company's risk. It's costly. It's not cheap. Someone at a post of chief risk officer would not come cheap. So it has a very big cost attached to it.
Understood, sir. Thank you so much.
Okay. So now moving to fit and proper criteria. Now, when we discuss about fit and proper criteria, as I mentioned, that the nomination remuneration committee is required to ensure that the fit and proper criteria is met by the company. Okay. Now, what are these criteria? So there is a specific schedule given under the regulations. Those regulations, you have to comply with those specifically. Okay, I'm not going into specific criteria that are there. You can just go and read them. Entire annexure is there, that these are the criteria that you have to meet. Apart from that, director has also to submit a declaration and undertaking that they are meeting these criteria. A deed of covenant, it's like a contract, similar to a contract, but it's called a deed. It's like kind of a declaration only, but there are multiple things. One, I've gave a declaration and another is a deed of covenant. Both of them, a director has to sign at the time of appointment. Okay. So they have to provide that to the company that they meet the fit and proper criteria. Of course, nomination remuneration committee has the responsibility of ensuring that as well. Apart from that, managing director of the company has to send a quarterly statement to the RBI saying within 15 days from the end of quarter, saying that all the directors meet the fit and proper criteria. Because as I mentioned, fit and proper criteria is very crucial. Here, I would like to remind you again, if there is a change of more than 30% or of directors, excluding independent directors, you need a specific RBI's approval for it, prior approval of RBI. Okay. Specific criteria, I don't want to get into session because these are direct criteria. Please go through and read through them once. Now, moving to disclosures and transparencies. There are certain disclosures that are prescribed. Again, there is nothing for me to explain into as much. A specific list is being provided. You need to disclose these items. Some are to be disclosed to board of directors, so it are presented into the meeting, some into the annual financial statement. I would again suggest you guys go through the corporate governance norm, read it once, because there is less of explanation there and more of direct statements to comply with. Okay. Another thing important, just one point and then just one point and I'm then
Okay.
Just one point. You need to form internal guidelines for corporate governance norms. So what are these internal guidelines? Basically, these norms are listed down as a policy, as you have for any other items. For this corporate governance section, you specifically prescribe internal guidance to, okay, this would be my audit committee, this would be a nomination committee, what would be my composition, what would be the TOR, how would they function, what will be the meeting frequencies. These are for committees. Apart from that, all other items for the corporate governance specifically, I have an internal guideline. I'm not saying it would be restricted to the compliance only. It has the entire corporate governance framework. Of course, if you're a larger company, you will be expected to have a much comprehensive framework for corporate governance. So whatever framework that you're following is to be put up into internal guidelines. These internal guidelines are actually published on your website. That's it on the corporate governance side. I had few queries, please.